So let's continue. As per AS 16, the borrowing funds to the extent of actual borrowings less any income from temporary investment from those borrowings needs to be capitalized. Now, the capitalization rate should be the weighted average of the borrowing costs applicable to the borrowings of the enterprise that are outstanding during the period. So what is the capitalization rate? It is based on the borrowing cost and not the capitalization rate. Okay, hence in the above case the treatment of Vital Limited is incorrect. Now going to the calculation, actual interest for 1920 is on 10% of 150 crores, which is 15 crores, less income from temporary investment 1.5 crores, giving you a borrowing cost to be capitalized as 13.50 crores. Okay. So this summarizes question number 5. Any doubts? Moving on to the next question. Question 6. Govind Limited issued 12% secured debentures of 100 lakhs on 1/4/2018 to be utilized as under: construction of factory building 40 lakhs, purchase of machinery 35 lakhs, and working capital 25 lakhs. So here what does this indicate? This indicates that it is a general borrowing which has been used for multiple purposes. In March 19, the construction of the factory building was complete and the machinery was installed and ready for use. Total interest on debentures for the financial year was 12 lakhs. During the year, the company had invested idle funds out of the money raised in banks deposits and earned an interest of 3 lakhs. You are required to show the treatment of interest as per AS 16 and also explain the nature of the assets. So when you say nature of the assets, we need to say whether they are qualifying assets or not. So let's go to the answer. As per AS 16, borrowing costs are that are directly attributable to acquisition, construction or production of a qualifying asset should be capitalized along with the cost of the asset. So the amount of borrowing costs eligible for capitalization should be determined in accordance with the standard. Other borrowing costs shall be charged to expenses. It also states that to the extent of the funds borrowed specifically for the purpose of obtaining an asset, the amount of borrowing costs are eligible for capitalization. So which means we need to do a proportionate calculation. Now let's calculate the eligible borrowing cost. 12 lakhs is the total borrowing cost, of which 3 lakhs has been earned as income, okay, from idle funds. So when we net it off, we get 9 lakhs as the net borrowing costs. Now coming to the classification. If you look at the construction of factory building, it is a qualifying asset. Purchase of machinery is not a qualifying asset even if the machinery has not been utilized. It is ready for use. Therefore, it is not a qualifying asset. And working capital definitely is not a qualifying asset. So in this case, for capitalization, we are going to take 9 lakhs into 40 by 100. What is 40? 40 is the amount invested in the construction of factory building. So 9 lakhs into 40 by 100, which gives you 3,60,000. And for the rest, we can also directly put 9 lakhs into 60 by 100, we can directly state, which totals to 5,40,000. So in this case, 3,60,000 will be taken for capitalization along with the cost of the factory building. So in this case, what will be the journal entry? The entry will be factory building or building account debit to cash or bank. Or if I have already paid the borrowing cost account debit to cash or bank, building account debit to borrowing cost. Okay. So 3,60,000 is to be capitalized, while 5,40,000 will be taken to profit and loss account. Right? Any doubts? This summarizes AS16 for the class. We are going on. Shall we continue? Yeah. Friends, we are moving on to the next standard, AS3. AS3, if you see, is more practical implication oriented standard. So from your examination perspective, it can be tested in two types. One, it can be asked as a 5-mark question where it is going to be a small question like any one of the activities or something like that, as a small question in 5 marks under your compulsory segment. Or you can have a full length detailed question, prepare cash flow statement, for 15 marks. Okay, so depending on what is your whatever is the question, your answering is going to differ. The detailed part will be covered by sir separately for as a part of your practical chapters, other chapters. So we will be covering this smaller aspects which get tentatively are tested in your 5-mark segment. Okay, so we will have an outline discussed today, and from here sir will take over for the detailed discussion. Yeah. AS3, cash flow statements. One most important point to remember, so far all the standards that you have learnt under group 1 are all mandatory standards, which means they are applicable to all the enterprises. Level 1, 2, 3, SMC, non-SMC, everyone. They are applicable to all enterprises. Whereas cash flow statement is one standard which is applicable or mandatory only for level 1 or non-SMCs only. For others, it is an optional standard. For others, it is an optional standard. See, the standard will never say this is not applicable to you. The standard will say it is mandatory to this segment. For others, if they want, they can by voluntary, voluntary compliance, they can do. But it is not mandatory for the others. So this standard is mandatory to level 1 and non-SMCs. Now the standard classifies the nature of cash flows into primarily activity-based cash flows and cash equivalents. So what is activity-based cash flows? Cash that is generated in the business. And what is cash and cash equivalents? The end result that you have, the cash balance, bank balance that you have in your books, and marketable securities that you have in the books. Now, when I speak about this cash flows that is generated from the business or generated from your entity, there can be three classification of activities. The first activity classification is operating activities, which relate to the business operations of the enterprise. Right? Second, investing activities, which relate to investments of the enterprise, which is long-term investments, okay, and predominantly which are generating revenue from investments. Financing activities is relevant to your financing activities, in other words, capital, borrowings and related expenses. So basically where we are going to raise funds for the business, right? So three types of cash flows: operational cash flow, investing cash flow and financial cash flow, right? For each of these activities, we can have a separate set of cash flow statement prepared. So what is a cash flow statement? It is a statement which reconciles the total inflows and outflows and gives us that, well, I had this much amount in hand, this much inflow has come, this is the total outflow, therefore this is what is the cash balance left in hand. So this is the entire idea of a cash flow statement, where we segregate the cash flows in three different places: operating, financing and investing. Now at your compulsory level questions, you can have each type of activity being tested separately. Each type of activity being tested separately, where they can ask prepare cash flow from operating activities or prepare cash flow from investing or financing activities. Or if they combine all the three, then there will be one or two adjustments only, very, very small adjustments. They can ask you to prepare a full cash flow statement. Now, when it comes to operating activities alone, we know that operations is a wider segment which has multiple items involved: sales, purchases, expenses, income. There are multiple items involved, and hence AS gives two methods of calculating the operating cash flows. What are the two formats that is allowed, or two methods that is allowed? Direct method and indirect method. Now when I speak of direct method, it is nothing but I am going to do a simple calculation of whatever has been received from sales, from in the form of income, other income, minus whatever has been spent as expenses, payments to creditors for purchases. So whatever has been received minus whatever has been paid or spent. So the format is cash received from sale of goods, cash received from trade receivables, which is your debtors, bills receivable, etc. Cash received from sale of services. Next, less cash payment for purchases, payment for trade payables, payment for expenses. Remember, under direct method, we will only be worried about the actual payment and receipts and not about accruals. Okay, actual payment, actual receipts is what is considered. So payment for operating expenses, payment for wages, salary, income tax. So all items will be considered and you find out your net cash flow from operating activities after adjusting any extraordinary inflows or outflows. So this is under your direct method. Now, moving on to the indirect method. What is this indirect method, my dear friends? Indirect method is the reverse working format, where practically I may not be able to identify each and every balance. When the entity size becomes large, I cannot find out each and every transaction from the bank statement. I will have at least 30-40 bank statements to deal with. So it becomes difficult for us to do the forward working. So the standard suggests let's go reverse. How do we go reverse? We start from the profit as per profit and loss account. And we remove all non-cash items. We remove all non-cash items from the equation to find out our net cash flow from operating activities. So how do we find that out? Closing balance of profit and loss account less opening balance of profit and loss account, which gives you the net profit earned for the period. What are all the reversals? Provision for income tax. Any other provisions? Okay, so let me also write that. Other provisions. Provision for doubtful debts, provision for a reduction in value of investments, any provision. Provision is a non-cash item. What is the other most significant non-cash item? Depreciation. Okay, it is given next line. There is a generic statement, but for your reference, you can make a note. Depreciation. Then changes because of extraordinary item, add or subtract if need be. Net profit or profit before tax and extraordinary items. Reversal of effects of non-cash and non-operating items. Now, why do we remove non-cash items? Agreed, because they are not forming a part of the cash flow. So, we are going to remove non-cash items like provisions, transfer to for depreciation and such items. What is non-operating items? They are those incomes and expenses which are forming part of either financing activities or investing activities, like borrowing costs, interest on borrowings, dividends paid to shareholders. Of course, dividends is an appropriation item. So anyways, another classic example will be profit or loss on sale of assets, which will be included in P&L account, but we need to remove that. Why? Because that amount is going to be adjusted under the head investing activity. Okay? Reversal of the effects of non-cash and non-operating items. Next comes changes in working capital except cash and cash equivalents. Now, why is this adjustment made? We understand. We have items like debtors, creditors, bills receivable, bills payable, short-term, other short-term advances, etc. Now, these items have moved during the financial year. So, during the beginning, there was one value of debtors. During the year end, there is some other value of debtors, which means there has been some transactions that has taken place in actual cash, which has to be adjusted for. Because they are balance sheet items, they will not reflect in P&L account. If I make a payment to debtor, the entry will be debtor account debit to bank account. P&L is not coming into the picture. But we are doing this method from profit and loss. So somewhere or the other, we need to adjust these transactions. Therefore, to give the effect of balance sheet transactions, related transactions, we adjust all working capital changes. In simple words, we make adjustments for current assets, current liabilities. Okay, so here it is changes in current assets and current liabilities. Okay. So when I say changes in current assets and current liabilities, it is opening minus closing. Okay. It is just the movement of opening minus closing. Now let us also remember this point. If there is a increase in the current asset, does it indicate a cash inflow or outflow? Outflow. Because when you are increasing your asset, you are paying money and acquiring an asset. So an increase in current assets indicates a cash outflow. Whereas an increase in the current liability indicates a cash inflow. Vice versa, a decrease in the current assets indicates outflow, whereas a decrease in the current liabilities indicates outflow. A decrease in the liabilities indicates outflow. Okay, so remember, how to remember this? Just remember any one thing. Balance all will be opposite impacts. Okay, remember one starting point. Increase in current assets means cash outflow. So increase ku enna pandringlo opposite than decrease. What you do for assets, opposite for liability. Like that you can remember like a matrix structure. Okay, if you remember one, the others will follow easily as a matrix. Less payment of income tax, adjustment for extraordinary items, which gives you cash flow from operations through the indirect method. Any doubts in the basic understanding? Okay. Moving on to investing activities. What is investing activity? Anything that is arising from long-term investments. Okay, so any increase in investments amounts to outflow. Any decrease in investments amounts to inflow. So first we are decreasing. So sales proceeds from sale of investments or sale of assets. Remember, we are not writing the profit or loss from sale of proceeds or sale of assets or investments. We are going to take the sale proceeds, which is the selling price or sales value. Add dividend or interest from investments. Income received from investments. Less any purchases of investments at actual cost. And any expenses relating to purchase of investments like brokerage, commission. So any purchases relating to, any expenses relating to purchase of investments, which gives you the net cash flow from investing activities. Next comes financing activities, which indicates issue of shares and debentures, including the premium received. Any borrowings or loans taken. Okay. When I say borrowings or loans taken, I will take whether the borrowings are short term or long term, doesn't matter. For me, any borrowings, whether short term or long term, will come under financing activities. Less dividend or interest paid. So interest is for debentures, loans, etc., while dividend is for your equity and preference shares. Less redemption of shares or debentures, including the premium, which gives you your net cash flow from financing activity. So this any one activity can also be tested under AS3. They can ask prepare cash flow from investing or financing activities for 5 marks. Please run through the formats once. Can we move on? We are going to the practice question, question number 7. This is going to be an exercise where you're going to classify each item based on the type of its activity. Let's start. Purchase of machinery, investing activity. Proceeds from issue of equity shares, financing activity. Okay, next, cash sales, operating activity. Proceeds from long-term borrowings, financing activity. Proceeds from trade receivables, operating activity. Cash receipts from trade receivables, operating activity. Trading commission received, commission again operating activity. Purchase of investment, investing activity. Redemption of preference shares, financing activity. Cash purchases, operating activity. Proceeds from sale of investment, investing activity. Purchase of goodwill, purchase of goodwill. When I say purchase of goodwill, it is still a cash item. Okay, it is purchased goodwill, not developed goodwill. So purchase of goodwill, it is an asset. So it is investing activity. Cash paid to suppliers, operating activity. Interim dividend paid on equity shares. So returns paid to shareholders, financing activity. Wages and salaries paid, operating activity. Proceeds from sale of patents, sale of intangibles, investing activity. Interest received on debentures held as investments. Debentures held as investment. So it is debentures held as for investment purposes. So investing activity. Interest paid on long-term borrowings, financing activity. Office administration expenses, operating activity. Manufacturing overheads paid, operating activity. Dividend received on shares held as investments, investing activity. If it is a dividend received from a subsidiary, even then a subsidiary investment is also an investment by nature, so it will also form under investing activity. Next, rent received on property held as investment, investing activity. Okay. So if your business itself is to rent out properties, in that case it will become operating activity. Okay. Next, selling and distribution expenses, operating activity. Income tax, operating activity. Dividend paid on preference shares, financing activity. Underwriting commission paid. Underwriting commission is generally paid for subscription of shares, okay, or subscription of debentures. So it is a financing activity. Rent paid, operating activity. Brokerage paid on investments, investing activity. Bank overdraft. Bank overdraft. It is a short-term loan. So short-term borrowings, it will also come under financing activities. So please remember, under financing and investing activities, we are not worried, especially in financing activities, we are not worried whether the finance is for a short-term finance or a long-term finance. If it is in the nature of finance, then it comes under financing activities. Even for working capital changes will, so if you are obtaining a loan for working capital changes like bank overdraft, cash credits, they are all still financing activities by nature. It will not appear under working capital changes. So that one line item alone will be excluded from current liabilities in the working capital heading. Okay, cash credit, financing activities. Short-term deposits. Short-term deposits is investing activity unless it is invested in marketable securities or bank balances. If it is either bank balances or marketable securities, now it will become cash and cash equivalents. Otherwise, it is investing activities. So remember, short-term deposits is investing activities. Okay, I think someone asked, what is the difference between bank overdraft and cash credit? Bank overdraft is generally given on a particular account where you can utilize in excess of the account, whereas cash credits can take two forms. Either they can partake the character of a short-term loan, or they can be partaking the character like a bank overdraft. So generally, in commercial parlance, bank overdraft and CC or cash credit take the same name. Both have the same meaning. But logically or theoretically, if you see, cash credit can also be a short-term loan like a working capital loan, where it will be like a normal loan, but it has to be repayable within 1 year, something like that. Yeah, so coming back, marketable securities is cash and cash equivalents. Refund of income tax received. What is income tax? Operating. So what will be refund of income tax? Operating activity. Marketable securities are certain securities which are held for immediate liquidity. So they are partaking the character of cash and cash equivalents. Short-term deposit within 3 months. Cash in, if it is specifically mentioned, if it is within 3 months, it is held within 3 months, then you can assume it as cash and cash equivalents. But if nothing is mentioned, you can write a note and take it to investing activities. So is the classifications clear? Yeah, so marketable securities, for the person who has asked online, marketable securities are those which are held for immediate liquidity as investments. So they can be immediately realizable at any time in cash. So because they are absolute liquid, they are classified on par with cash and bank balances. Okay? Examples in the investments that you hold, say investments in shares and debentures, etc. There are some kind of investments which you can immediately liquidate, like some demat accounts or some online investments that you can immediately liquidate and take cash out of it. Whereas you can also have some investments in the nature of gold, silver, bullions. They may or may not be marketable. Okay, if you see, especially banks and other financial companies, they will maintain both type of investments. They will maintain marketable securities. They will also maintain the normal investments, because those marketable securities will come in hand when they have to do immediate liquidity, right? Yes, Vijay Lakshmi, long-term deposits is financing activity. Sorry, deposits, if it is deposits as an asset, then it is investing activity. If it is any borrowings or public deposits taken, then it is financing activity. So classifications are clear? Any doubts with respect to the classifications? Okay, so that given, let's continue. Question number 8. This was one of your past asked questions. Prepare cash flow statements of Kama Limited for the year ended 31st March 2021 in accordance with AS3 from the cash summary account. So it is basically a cash account of receipts and payments from where we are going to prepare the cash flow statement. So first thing that we are going to do is classify the items into 3 or rather 4, including cash and cash equivalents. We are going to classify them. So let us start. Opening balance. It is the opening cash and cash equivalents. Next, receipts from customers, operating activity. Sale of investments, investing activity. Issue of shares, financing activity. Sale of property, plant and equipment, investing activity. Now before I go to the outflows, if you see there are 2 sales that are given. The amount is as per the cash summary account, which is this indicates the actual sales proceeds. Is the profit or loss on sale relevant to us for cash flow statements? No. We are not going to be bothered about what is the profit or loss unless we are going to prepare operating activity under indirect method. For indirect method alone, we will be adding back that profit or loss. But otherwise, when you prepare investing activities or financing activities, we are not going to consider whether there is a profit on sale of investments or loss on sale of investment or assets. So is the inflows part clear? Moving to the outflows. Payment to suppliers. Operating activity. Purchase of investments. Investing activity. Property, plant and equipment acquired. Investing activity. Wages and salaries. Operating activity. Payment of overheads. Expenses. So operating activity. Taxation. Operating activity. Dividends. Dividends is given here as an outflow, which means it is a dividend paid. So it is a financing activity. If the same dividend was given in the inflows segment, then it becomes dividend received, which is investing activity. Right? Next, repayment of bank overdraft. Bank overdraft is a financing activity. Interest paid on bank overdraft, financing activity. And we have the closing balance of cash and cash equivalents. So can we start preparing the format? Let us start. Cash flow from operation, opening cash and cash equivalents. The next, we are going to start items one by one. Cash flow from operating activities. Under that, we have first write all your inflows, then you can write your outflows. So under the inflows, we have receipts from customers 74,682. Receipts from customers 74,682. Next, payment to suppliers. So all outflows. Payment to suppliers 54,918. Next, cash payment for wages and salaries 1863. Friends, please ensure to maintain a columnar format of working. which will enable a neat presentation in your exams as well. Cash payment of overheads 3105. Which gives you the cash generated from operations 14,796 minus payment for tax 6,561, giving you cash flow from operating activities as 8235. 8235. Friends, what method is this? Is this direct or indirect method? This is direct method. So generally when receipts and payments account are given, we follow the direct method. When we have the profit and loss and balance sheet available, then we go by the indirect method. Moving on. Okay, insurance claim received, someone has asked. Insurance claim received can be shown before payment of taxation or after payment, saying add insurance claim received, because they are extraordinary items. Under operating activities only, you will show them as a separate item as adjustment for extraordinary items. Yeah. So I hope that clarifies. Moving on. Cash flow from investing activities. Proceeds from sale of investments 459. Proceeds from sale of property, plant and equipment 3456. Less purchase of investments 351. Less purchase of property, plant and equipment 6210. Which gives you cash used in investing activities, because it is coming as an outflow or net outflow. It is cash used in investing activities 2646. Cash used in investing activities 2646. Next, can we move on to financing activities? Cash flow from financing activities. Proceeds from issue of shares 8100. Proceeds from issue of shares 8100. less payment of dividend 2160. 2160. Repayment of bank overdraft 6750. Repayment of bank overdraft 6750. So remember, under the indirect method, again I am repeating, bank overdraft, if it appears as a part of current liabilities, do not adjust under operating activities. We need to take it under financing activities only. Interest paid on bank overdraft 1350. Which gives us net cash used in financing activities 2160. 2160. So net changes or net movement in cash and cash equivalents is 3429. Which will summarize to your closing cash and cash equivalents 4374, which is nothing but the closing balance as per your cash summary account. 4374 closing cash summary. So the net cash increase or decrease is going to be 3429, excluding the opening balance. I am saying 3429 excluding your opening balance. Right? Any doubts in this question, friends? Any doubts with respect to AS3? Detailed questions, you will be doing it as a separate learning area. So we are not focusing it in today's session. Jayaseelan, refund of income tax will be taken under operating activities. So this summarizes our quick recap on AS3. Moving on to the next standard, which also is similar in terms of your examination approach. AS13, accounting for investments, which is the 8th AS, which is, or the last AS that is covered under group 1. Again, this question, if asked under 5 marks, is more theory oriented, where they can ask you questions relating to whether it is a current investment or a non-current investment, or classification, reclassification, all these questions can be there. Rarely under 5 marks, they will ask you to prepare investment account. But if asked, it is a very small account that is to be prepared. But detailed question, prepare investment account with all adjustments, is going to be a separate area where it will come either in from question 2 to 5. In that segment, it comes generally for 10 marks. Okay, so that is a separate area of discussion. Under AS compulsory question segment, 5 mark question, the focus is more on the theory portion. Okay, so let us focus on the theory area of learning. AS13, accounting for investments. What are investments? Investments are assets held by the enterprise for earning income by way of dividends, interest, or rentals for capital appreciation or other benefits. So investment here is not only investment in shares and debentures as per AS13. Even if you have any investment for renting, okay, for rental purposes, my sole objective is holding this investment for giving it on rent, even then it is classified as investment under AS 13. A classic example is machinery rents. Rent of this machinery which is given for road contracts, all these things. So if the objective itself is to earn rental revenue from it, then it is classified under AS 13 as investments. But assets held as stock in trade are not classified as investments. Okay, even though the objective is to earn revenue from it, they are not classified as investments. So here, if you see, there will be a small overlap between AS 10 and AS 13. So, if it is going to qualify as an asset under AS 10, AS 10 will prevail. If it is going to get classified as AS 10 asset, then AS 10 will prevail. Other investments for rental purposes get classified under AS 13. Next, investments can be classified into two parts, current investments and non-current investments. What is a current investment? Where the intention of the investment is that it should be readily realizable. I am holding it for immediate realization or easier realization, and generally the investment is not made for a period exceeding 1 year. But please remember, the period does not matter under the intention of classification of current and non-current. At the time of investing, if you decide that I am going to hold it not for more than 1 year, or if you hold it for more than 1 year, the intention at the time of investment matters. For instance, on 1/4/2021, I decided I will buy some investments. Probably in 3 or 4 months, I will sell it off. Okay. Now, currently in the situation, I am not able to sell it due to the global crisis, due to fall in prices. I am waiting for some better prices. So, your asset is now being held for more than 1 year. Is it non-current? No. At the time of purchasing the investment, your intention was to hold it for less than 1 year, or your intention was to realize amount from that asset. So it will still be classified as current investment only. Whereas, okay, the long-term investments are opposite. The intention is to hold for income and not for realization. The intention is to earn income from it. I invested in the shares of XYZ company. I thought I will invest it, I will keep receiving dividends as income. Unfortunately, within 6 months, that company is not doing well or some prices are fluctuating. I am not comfortable, so I am selling it off. Just because you are selling it within 6 months does not make it a current investment. The intention at the time of purchase was to hold it as a long-term investment, and therefore it will get classified as non-current or long-term investment only. So under AS 13, the standard is very clear. The period is not the criteria, the intention becomes the criteria of classification. A current investment is an investment which is by its nature readily realizable and is intended to be held for not more than 1 year from the date of investment. The intention is to hold for not more than 1 year is to be judged at the time of purchase of investment. Ma'am, in the exam, if they give me the dates and ask me to calculate, how do I do? If you do not have any other information, then go by the classification. More than 1 year means long term, less than 1 year means short term. But if the question is clear that this is current and this is non-current, or they decided to classify as current and non-current, go by that classification. If that information is absent alone, go by the date. Am I clear? This date-wise classification was, I guess, a last previous examination question. Classification of investment based on current and non-current based on the date was a previous exam question. I think July or December 21 attempt it was asked. Right? Moving on. What is the cost at which we need to recognize? The investment is recognized, if it is current investment, at lower of cost or market value. It is initially recognized at cost. When you record the investment, it will be recorded at cost. But at the year end, you need to measure. For current investments, you need to measure whether cost or market price, whichever is less. Whereas if it is a long-term investment, it is continued and carried at cost. However, if there is a decline which is not temporary, which means if there is a permanent decline in the value of the investments, then that decline is taken to profit and loss account. Similarly, this year it was a decline. 2 years later, that investment is again picking up. So can I reverse the amount to the P&L account? Yes, you can reverse the amount that you had initially recorded. So let us recap again. Investments, if it is current, it has to be at the year end measured at cost or fair value or market price, whichever is less. If it is not long-term investments, always carry at cost. Whereas if there is a permanent decline, the decline has to be taken, the difference has to be taken to profit and loss account. And if the decline is going to get reversed in the future, subsequently you can also reverse the amount in the profit and loss account. So now coming to the most repeated area of testing under this 5-mark segment, reclassification of investments. When a long-term investment becomes current, current investment becomes long-term. Now how this reclassification happens? It will not ideally happen based on date. It will only happen based on the intention to convert. Okay, in the question, if any other information is absent in the exam, then use date as the basis. But primarily, it is based on the intention to convert. So first, let us see the first conversion. When long-term investments are converted to current investments, then the conversion is made at the lower of cost or carrying amount on the date of transfer. I am not using the word fair value here. I am using the word carrying amount on the date of transfer, which means it is made at the lower of actual cost or actual book value on the date of transfer. You can ask, ma'am, in long-term investment, cost will be the book value. Suppose you had recorded a decline in the value of the asset, permanent decline, the cost would have reduced. That reduced value will be taken, irrespective of what the market value is. So let's understand this using an example. Let us assume a long-term investment cost is 100. I had recorded a permanent decline of 20 rupees. So the carrying cost or book value currently is 80. Now on the date of transfer, the market price or fair value is 95. Say probably after that the market picked up, the fair value is increased. This is not relevant during the conversion. We are going to consider cost or carrying price, whichever is lower. So we are going to take it at carrying cost 80. Even if this is not 95, this is 65, don't bother. We will only carry it at 80 rupees. Now you can think, ma'am, then if it is 65, then prudence we are not considering. The moment it gets converted to current investment, at the end of the year, investment will be valued at cost or fair value. So that time fair value will be taken care of. We don't have to worry. So at the time of conversion, market price or fair value is not at all relevant if it is long term to current. Next, the opposite side. When investments are converted from current to long term, it is made at the lower of cost or fair value at the date of transfer. So here, if it is current investment, say let us say cost is 100, fair value is 85. Long-term investment will be carried at cost only generally, or it can be carried at fair value or market value, whichever is less. Let us assume it is the market value is say 75. Doesn't matter. We are only going to be considering, the book value is say 75. So we are only going to consider the fair value and not the book value or the carrying cost. Okay. So remember, if it is long-term investment, book value is relevant. Cost is always there. Renduthiliyume cost is always there. How to remember easily? For long-term investment, book value is relevant. For short-term or current investment, fair value or market value is relevant. Okay, 2 hints for us to remember. So this is about reclassification of investments. Please go through. These are your questioning areas from the AS related portion, which is the 5-mark segments. Can we go to the practical questions? We are starting with the practical questions. Question number 9, which is your May 22 RTP question. JVR Limited has made an investment of 97.84 crores equity in shares of QSR Limited in 1617. The investment was made at par. QSR Limited has been earning continuous losses for 2 years, and JVR Limited is willing to reassess its carrying amount of investment in QSR and wishes to provide the diminution, which is decrease in the value of investment, for the year ended 31st March. Discuss whether in the connection of JVR Limited to bring down the carrying value of investments is in accordance with the AS. Answer. Here, if the investment has been held with the intention to hold it for more than 1 year, then it would have been classified as a long-term investment. Therefore, any decline in the permanent cost of the asset or permanent cost any permanent decline in the investment shall be taken to profit and loss account. Here, the crux is you should not conclude that this is a long-term investment. Just because they are saying it is 1617, if you conclude that that is a long-term investment, you are right, but you are not 100% right in your answer. If you have to be 100% right in your answer, you should say, if JVR Limited has classified it as a long-term investment, because we all know AS 13 is about intention and not exactly about time period. Okay, so we should say that if JVR Limited has classified this investment in QSR as a long-term investment, then the same shall be carried at cost and any permanent decline shall be adjusted. So let us check the answers. Yeah. As per AS 13, investments are classified into current and non-current or long-term. A current investment is an investment which is readily realizable and intended to be held for not more than 1 year. The carrying amount is lower of cost or fair value. Any reduction in fair value and any reversals are included in the statement of profit or loss. Long-term investment is an investment other than current investment. Investment referred in the question can be classified as long term as they are usually carried at cost. Okay, or you can say investments here are classified as long term assuming that the company has intended to hold it for more than 1 year. However, where there is a decline other than temporary in the value of the long-term investment, then the carrying amount is reduced to recognize such decline. The contention of the company to bring down the value of investment may be correct if the decline is of permanent nature and the decline may be charged to profit and loss account. Hence, the contention is valid. Right? Here, why we are giving both current and non-current long-term explanation is because, like I told you, the intention of the company we do not know. So, we will write both the answers here. Please take down the relevant hints. Next, can we move on? Question 10. A Limited on 1/1/2020 had made an investment of 600 lakhs in equity shares of B Limited, of which 50% is made in the long-term category and the rest is temporary investment. The realizable value of all the investments became 200 lakhs, which is the entire 600 has become 200 lakhs. As B Limited lost a copyright case. How will you recognize the reduction in the value of investments in the financial statements for the year ended, considering the downfall is non-temporary? Here, the difference has to be taken to profit and loss account. Answer is very simple, but we have to present it in two manners. 50% current investment, it has to be recognized at cost or market price, whichever is less. Here, since the market price has also has reduced, we can say it has to be recorded accordingly. For the remaining 50%, it is recognized at cost. However, since the decline is not temporary in nature, the amount of decline shall be recorded in profit and loss account. So, when you write the answer, we need to give it under two different buckets. So, let's check the answer. A Limited invested 600 lakhs in the equity shares of B Limited. Out of the same, the company intends to hold 50% of shares for a long-term period and the remaining as temporary investments. Irrespective of the fact that A Limited has only held the asset for 3 months, AS 13 emphasizes that the intention of the investor to classify as current or long term even though it is readily marketable. So which means here the date or the period for which it is held is not relevant. What is relevant is the intention to hold. Right? As per AS 13, investment is carried at of current investment is carried at lower of cost or fair value. In respect of current investments for which active market exists, market value is the estimate of fair value. Accordingly, the carrying value of investment held as temporary should be shown at realizable value 100 lakhs. Why 100 lakhs? 200 lakhs is the total reduced value of which 50% is temporary. So 100 lakhs. The reduction of 200 lakhs, which is 600 lakh, 300 lakhs is current, which has now become 100. Therefore, 200 lakhs reduction will be charged to profit and loss account. So, this is current investments part of the story. Next, The standard further states that long-term investments are usually carried at cost. However, if there is any decline other than temporary, then in the value of long-term investment, then the carrying amount is also reduced to recognize the decline. Here, B Limited has lost a copyright case which has reduced the realizable value of the shares. Therefore, losing the case of copyright may affect the business and performance of the company. This you need not write this. You can be directly upfront in the answer. Accordingly, it is appropriate to reduce the carrying amount of investment by 200 lakhs and show the investment, which is the balance 50 portion, at 100 lakhs, as the downfall of the shares is not temporary. This reduction will be also recognized in the profit and loss account. So here we need to show the answer in two parts. Though both are in P&L account only, we cannot show it together. If you are showing together, then the way in which you answer will not reflect the right answer. Okay. So this is about question number 10. You can take down hints wherever necessary. The answers will again be circulated in the PDF. Don't worry. Friends, like I told you, ensure you are addressing the keywords. You need not be, elaborate in answering every point. Ensure you are addressing the keywords. And generally, when I will always assume that when you answer a AS question, it should not go beyond half a page. I mean, the theory part as such. Not beyond half a page if it is an out and out theory question. That is how I assume, so that we are crisp and upfront in answering. You should not write pages and pages as answers. Okay, and if it is a longer question like this where you have to answer in two parts, not more than one page. If you keep that kind of see, the page is only an indicative factor. அதுக்காக ஒரு பேஜ்ல தான் எழுதணும் அப்படி கிடையாது. The idea is keep it as brief as possible. Don't make the examiner search for the answer. Show him that this is where I have written the answer. Please see, please give marks. Go. Okay, don't make them read your entire thing and see what you have written. Make them find the answer. Try to highlight your answer wherever possible, right? And try to be as brief as you can in your answering. Well, we will discuss the paper presentation, preparation, etc. in the last part of the session today. Question number 11. Can we move on? Kunal Securities wants to reclassify investments in accordance with AS 13. Past us question. State the values at which the investments have to be reclassified in the following cases. First, long-term investment in company A costing 10.5 lakhs to be reclassified as current. The company has reduced the value of these investments to 9 lakhs to recognize a permanent decline. Fair value on the date of reclassification was 9.3. So when a long term is converted to current, what are the values that we need to take? Cost or carrying cost or book value. Carrying cost or cost, whichever is less. So in this case, it is 10.5 or 9 lakhs, whichever is lower. 10.5 or 9 lakhs, whichever is lower. Next, long-term investment in company B costing 14 lakhs has to be classified as current. Fair value on the date of classification is 16, book value is 14. So cost or it is again a long-term investment, so it is to be taken at cost or book value, whichever is less. Here, since it is the same, 14 lakhs will be considered. Next, current investment in company C costing 12 lakhs is to be reclassified as long-term investment. Company wants to retain them. The market value on the date of classification was 13.5. So for a current investment, what is the base? Cost or market price, whichever is lower. So 12 or 13.5, whichever is less, therefore 12 lakhs carried at cost. Next, current investment in the company D costing 18 lakhs is to be reclassified as long-term investment. Market value on the date of classification is 16.5 lakhs. So what is the value that we need to take? Cost or market value, whichever is lower, 16.5 lakhs. Right? So remember the reclassification rule. If it is current to non-current or current to long-term, it is cost or market value. If it is long-term to current, it is cost or carrying cost or book value. Right? Any doubts in question number 11? Okay. So I'm repeating your rule for your clarification again. If it is reclassification, current to long term, it should be taken at cost or market price. If it is long term to current, it is cost or book value or carrying cost, whichever is lower. So with this, we summarize our discussions on accounting standards. Friends, 20 marks minimum, up to 25 marks, okay, can be tested from this AS segment. And your compulsory question has always been, ever since I have known the ICAI papers, it has always been compulsory question AS. So do not leave this segment. Okay, spend separate time on learning the AS segment. And do not leave even one AS. You have only 8 accounting standards covered as a part of group 1, which is 8 simple standards for us to remember. Okay, so do not skip any of the accounting standards. AS kulla choice vidadinga. Okay, and AS ayum choice vidadinga. Right? So please remember this 20 marks, and preferably I would recommend, the choice is yours. I would recommend, if you are confident in AS questions and if you attend them first, okay, they give a very good edge over in your papers in terms of scoring, because if you are answering AS questions tactfully, clearly and presenting clearly, the examiner's impression on your paper will naturally increase. Even after that, if you tend to make some small mistakes in the calculation, etc., also the impact of it is a little lesser. This is something that I have seen from feedbacks from a lot of students, my personal experience with writing papers, etc. When you are writing or starting with the AS questions, provided you are very confident in the AS questions, முதல் கொஸ்டினே தப்பா ஆரம்பிக்க கூடாது. That is also there. So start with the most confident question, and I would prefer you to be very confident in AS and start with AS questions. Right? It has a very good edge over in your exam. Okay. So with this, we complete our AS related discussions. We will break for lunch now and resume after lunch for the next topics, which is redemption of debentures and preference shares. And after that, we will also have some small session to understand on how we need to prepare for your paper for accounts, etc. Right? So take a break and we will resume. after lunch. We will resume in 45 minutes from now.